This lecture will cover the audit of cash. Cash is the lifeblood of any organization, and as auditors, it is crucial to understand and assess the reliability of an entity's cash balances. We will delve into the key concepts, procedures, and challenges associated with auditing cash. We will explore the importance of cash in financial reporting and its impact on an organization's overall financial health. Cash is not only a key asset, but also a critical indicator of an entity's liquidity and operational capability. As auditors, the role is to ensure that the reported cash balances are accurate, complete, and in compliance with accounting standards. We'll discuss the inherent risks associated with auditing cash. Misstatements in cash balances can arise from various sources, such as fraudulent activities, errors in recording transactions, or inadequate internal controls. Understanding these risks is fundamental to designing effective audit procedures. We will explore the audit procedures specifically tailored for cash. This includes confirming cash balances with financial institutions, testing the completeness and accuracy of cash receipts and disbursements, and evaluating the effectiveness of internal controls related to cash transactions. Auditors use a variety of audit procedures to gather evidence and test the accuracy and completeness of cash balances. When focusing on cash, three key sources of evidence are often examined: the Cash Disbursements Journal, the Cash Receipts Journal, and bank reconciliations. The nature of audit evidence associated with cash disbursements includes auditors examining the Cash Disbursements Journal to verify the legitimacy and accuracy of recorded cash outflows. This involves examining supporting documents such as invoices, receipts, and other payment authorizations. Canceled checks and electronic payment records are commonly inspected to ensure that payments were indeed made to legitimate vendors and for valid business purposes. The nature of audit evidence associated with cash receipts include the auditors reviewing the Cash Receipts Journal to confirm the legitimacy and accuracy of recorded cash inflows. This involves examining supporting documents such as sales invoices, customer receipts, and deposit slips. Cash register tapes, point-of-sale system reports, and other relevant records are inspected to ensure that cash sales are accurately recorded. Auditors review the bank reconciliation prepared by the entity. They rely heavily on bank reconciliations to verify the accuracy of cash balances. Bank reconciliations reconcile the differences between the cash records maintained by the entity and those reported by the bank. Unexplained reconciling items or adjustments may indicate errors or fraudulent activities and require further investigation. Auditors confirm the existence and ownership of bank accounts directly with financial institutions. Interbank transfers typically involve the movement of funds between different bank accounts within the same entity. Auditors examine the schedule of interbank transfers to verify that all interbank transfers, both incoming and outgoing, have been properly recorded and included in the financial statements. They also investigate any unusual or unexpected patterns in interbank transfers that may indicate errors, fraud, or irregularities. Cash is highly liquid and can be easily misappropriated by individuals within the organization. There is a risk of unauthorized individuals gaining access to cash, leading to misappropriation or theft. This risk is higher in environments with weak internal controls or inadequate segregation of duties. Cash transactions are susceptible to various fraudulent activities, such as embezzlement, skimming, or manipulation of records. Fraudulent activities can result in the misstatement of cash balances, impacting the accuracy of financial reporting. Employees may engage in schemes to manipulate cash records for personal gain. Businesses heavily reliant on cash transactions, such as retail or hospitality, face increased risk. The high volume of cash transactions in such industries makes it challenging to maintain effective controls and monitor all cash-related activities, increasing the risk of misappropriation or errors. Transactions involving foreign currencies introduce additional complexity and risk due to exchange rate fluctuations. Fluctuations in exchange rates can impact the valuation of cash holdings and result in misstatements if not properly accounted for. The risk is higher for entities conducting significant international transactions. Strong internal controls over cash are essential for ensuring the reliability of financial information, preventing fraud, and maintaining the integrity of an organization's operations. Dual custody of cash at all times is an important control mechanism designed to enhance the security and accountability of cash assets within an organization. The concept of dual custody involves requiring the involvement of two or more individuals in certain key aspects of cash handling and management processes. This practice serves as a preventive measure against fraud, misappropriation, or errors, and is often a fundamental component of a robust internal control system. For example, for certain cash transactions, especially those involving significant amounts, two authorized individuals must jointly approve or authorize the transactions. This could include approving cash disbursements, transfers, or other financial transactions. Physical possession of cash or access to cash storage areas may require the presence of at least two individuals. For example, when assessing a cash vault or handling cash in a cash room, two employees may be required to be present to ensure that one person does not have the sole control over the cash. Dual custody may be implemented for signing authority on checks or other negotiable instruments. In such cases, two authorized signatures are required to validate the transaction. This helps prevent unauthorized or fraudulent disbursements. In an electronic or computerized cash system, dual custody may involve requiring two individuals to access certain functions or perform specific transactions. This ensures that no single individual can manipulate or misappropriate funds without the knowledge or involvement of another party. A lockbox arrangement is a financial service provided by banks to streamline the collection of payments for businesses. This arrangement involves the use of a post office box or lockbox, which is maintained by a bank. The purpose is to expedite the processing of incoming payments, particularly checks, to improve cash flow and reduce the time between the receipt of payments and their availability for use by the businesses. Typically, a customer will send their payment, such as a check or remittance devices, to the designated lockbox address. This address is typically associated with a business, but is maintained and monitored by the bank. The bank collects the payments directly from the lockbox. This is often done multiple times a day to ensure quick processing. The bank processes the payments, deposits the funds into the business's account, and provides the business with a detailed report or electronic file summarizing the payments received. This report may include information such as the check number, invoice number, and payment amount. Fidelity bonds serve the purpose of protecting businesses from financial losses resulting from dishonest or fraudulent acts committed by their employees. These bonds are a type of insurance coverage that provides coverage for losses caused by employee theft, embezzlement, or other fraudulent activities. The primary purpose of Fidelity bonds is to safeguard businesses against the financial repercussions of dishonest acts by their employees. Auditing bank reconciliations is a critical component of the overall audit process, as it helps auditors verify the accuracy and completeness of cash balances reported in the financial statements. Auditors typically start by confirming the bank balance directly with the financial institution where the client holds its accounts. This confirmation process involves sending a confirmation request to the bank, asking for confirmation of the client's ending balance on a specific date. The confirmation from the bank serves as an independent third-party verification of the cash balance reported by the client. It helps ensure that the amount recorded in the client's records matches the amount on the bank's records. The confirmation process includes the date specified by the auditor. This helps auditors confirm that the bank balance matches the client's balance as of the audit date. Alongside confirming the bank balance, auditors often request a cutoff bank statement. A cutoff bank statement covers transactions that occurred shortly after the client's year-end, but were recorded before the balance sheet date. The cutoff statement helps auditors verify that all relevant transactions that occurred around the balance sheet date are included in the client's financial records. This is crucial for ensuring that the financial statements are complete. It assists in verifying that transactions are recorded in the correct accounting period, addressing the risk of misstatements due to timing differences. Deposit in transit refer to funds that have been submitted to the bank by the company but have not yet been credited to the company's bank account. This is a critical consideration in the reconciliation process, and auditors focus on examining evidence to ensure that the deposits are properly authorized and supported by valid documentation. Outstanding checks are checks that have been issued by the company but have not yet been presented to the bank for payment. The examination of outstanding checks is crucial for ensuring the accuracy and completeness of the cash balance. Auditors will examine the authorization for the issuance of outstanding checks and ensure that the checks are supported by appropriate documentation, such as invoices or other payment support. Large or unusual outstanding checks are subject to closer scrutiny. The auditor investigates the business purpose of these checks and ensures that they are appropriately documented and authorized. Bank debit and credit memos represent adjustments made by the bank to a company's account. The auditor examines the authorization for bank debit and credit memos to ensure that adjustments are properly approved. Additionally, the auditor reviews supporting documentation such as correspondence with the bank or other relevant documents to verify the legitimacy of the adjustments. The auditor may also focus on any unusual or large bank debits or credit memos. Such items may indicate errors, discrepancies, or potentially fraudulent activities. Investigative procedures are performed to understand the nature of these transactions and verify their accuracy. Verifying the book balance is the final step in the audit of cash. Once the auditors review the bank reconciliation prepared by the client, the auditor will ensure that the reconciliation is mathematically accurate and trace the general ledger cash balance to the trial balance. Bank confirmations are a standard audit procedure used to verify the accuracy of a company's reported cash balance. Traditionally, bank confirmations were sent via postal mail, but advancements in technology have introduced electronic confirmations as an alternative. Electronic confirmations are sent and received through a secure online platform. The platform automates the confirmation process, reducing manual intervention. These confirmations often lead to faster responses as the transmission is nearly instantaneous. The automated nature of electronic confirmations can save time for both auditors and banks, streamlining the confirmation process. Additionally, electronic platforms often incorporate advanced security features, including encryption and authentication, to ensure the confidentiality and integrity of the information. Auditors can track the status of confirmations in real time, enhancing transparency and accountability. Electronic platforms maintain a comprehensive audit trail, facilitating documentation and review during the audit process.